Well, hello, traders and investors. Today is Thursday, September 3rd. It is almost the end of the week. We have important employment numbers today. We have jobless claims coming out. That's the big report today. Tomorrow we have unemployment data. We're looking at a consensus between 910,000 and 1.175 million. Again, the 4-week moving average is just a little over a million. The consensus is right at 958,000. The truth of the matter is, any number that's below the 4-week average is good enough. Anything below 1.68 million is kosher. But I think we're going to get below million. The number has been going down substantially. So look for the number. If the number is above a million jobless claims, that could be a problem for the market. If it's below a million, and I think it will be because the 4-week moving average has been slowly moving down, I think we'll be in better shape. Let's talk about global economy. And then I'm going to talk about two stocks that are on my chopping block. And yes, I'm going to say I told you so, like I did 2 weeks ago. So, major stock indexes melted up. Biggest daily gain since July. London, Frankfurt, Tokyo advanced, Shanghai declined. Investors are encouraged by central banks' infusion of credit into struggling economies in hopes for a vaccine. We're actually supposed to get an update on that today, to end the COVID-19 pandemic that has plunged the world into the deepest economic environment since the Great Depression. It's amazing, really. It's amazing how far we've gone in terms of eroding the gains we have made, and it's amazing how much we've bounced. I got to say, the world is really extreme right now because this COVID-19 is so bad, but at the same time, the Fed has been putting in so much money into the market, it's kind of balancing each other away a little bit, and ultimately causing the market to get near or at all-time highs. Forecasters warn that the stock market recovery might be running too far ahead of economic activity. Yes, I'm warning that too. The market's just getting too hot right now as the United States and some other countries reimpose antivirus controls that hamper businesses. U.S. stocks have gained despite lack of agreement in Congress on a new economic aid with additional unemployment benefits to support consumer spending. And I'm going to tell you why they've gained, because the Fed came out last week and said they're going to keep supporting the market even if we get to the 2% growth rate, inflation rate that we had prior to this pandemic hitting us. And that's really, really big because think about it. If we can get back to where we were and continue getting the same amount of aid, folks, this aid caused the global stock market to double in size, all right? Back last time we had this correction. So this is really, really big. Report by payroll processor ADP, this is really big because ADP tells us what to expect on the Friday's unemployment data. Widely watched as a forerunner of government's employment data due Friday, as I just said, showed that private sector added 428,000 jobs, less than half the 1 million expected by forecast. So again, the forecast, if I show you the forecast, I mean, you got to see this. Let's see if they've updated this. I mean, up to about a few weeks ago, it was literally all over the place. But let me see if I can get you a number here. Look at this. Look at this number. 435,000 to 2 million. What kind of a forecast is that? Why not just make it 100,000 to 100 million? I mean, when you see forecasts like this, it's telling us that analysts have absolutely no clue what to expect. I'm not kidding. This is kind of like throwing darts at the board. But the consensus is 1.4 million. If the labor market is showing better jobless claims, more than 1.4, we should be in better shape. But again, look at this number, 435,000 to 2 million. I mean, it's crazy. It's crazy. So again, keep your eye on this number, and this is the consensus, 1.4 million. Let's go back to our report here. Added 428, less than half the million expected. Analysts said that it could be a warning sign that job market is cooling after some states reimposed antivirus controls and expiration on supplemental employment benefit cut into consumer spending. So far, consumer spending has been off the charts. Also, Wednesday's Federal Reserve said August survey of business found enduring uncertainty over the pandemic and the harm it's caused to consumer and business activity. Healthcare and communication stocks helped drive the market rally. Again, What the news is telling us that is that we may be flying a little too high too fast. Now, I showed you momentum levels yesterday, and they truly confirmed that. The market is heating up hard to the upside. Now, does that mean we're going to have a major correction? Absolutely not. It does mean that this rubber band is extended and it needs to cool off. Now, I'm not going to get into momentum levels because I literally show them to you every day. But again, there's more or increased vulnerability. About 85 out of 100 NASDAQ 100 stocks are trading above the 200-day moving average. That number is not sustainable. It is just not sustainable. And I want to show you this last thing. Let's go to Stock Fetcher. Oh, excuse me. Let's see, put the call ratio. You see here, notice even when it backs up, the highs have been going lower and lower and lower. That means the market is really becoming overly bullish. Now we went to 0.625 and we bounced hard off of that, but we're only bouncing to 0.74. In other words, that rubber band is not coming back all the way. It's being stretched out to the bull side, and then it's doing this. There's only so much it can go. The problem is there's tons and tons of stocks that are going to go down hard because they're near new lows instead of new highs. Then that's what I want to talk about today. Now, I'm going to say I told you so because I told you this was going to happen a few weeks back, maybe even earlier than that. But I know we've been getting a lot of views on this topic, energy sector. So let me show you what's going on. Remember, the stock market is heating up. It's over hot. Oh, way over hot. Overheating. If you look at the energy sector, look at this. This is my cumulative. Look at this. Down 3%, down 16%. All right. And if you look at the energy sector here, by the way, notice something interesting. Look at barrel prices. We were at $43.70, $43. Now we're at 41. That means U.S. companies are bleeding again. Why? Because it costs more than $41.15 to buy a barrel of oil. And then they have to process that. So it's like adding insult to injury. So when I see oil going below $43, $42, it starts cooling off again. When we look at the energy sector, what do we see? We see it coming back, and now we're seeing it cooling off, and it's near all-time lows again, right? Let me extend the time period for you. 9 months, look at this. Rallies, never hits the 200-day moving average, backs away, and now it's trading below the 50-day moving average, and it's moving lower. Again, why? Well, partly because energy prices are moving lower. Again, it costs U.S. companies more than $41 to buy a barrel of oil. So it's not looking good for energy companies. And if the whole market is overbought, and if it starts cooling off, what do I always tell you? The strongest stocks, the stocks that have gained the most, will keep those gains the most. And the stocks that are the most vulnerable will sell off. So stocks are overbought. Energy sector is cooling off. Energy prices are now below $43 a barrel. And the energy sector is, as I just showed you, going in for another dive. Let's go closer. Bounce, bounce, bounce. And this is while the stock market's making all-time highs. So I've got two companies on my chopping block. Chopping block. One is Holy Frontier. What did they do? And before you even see what they do, why don't we look and see what they're doing? New lows, new lows, new lows. While stocks are making new highs, new lows, near new lows. Not all-time lows, but look at where we were. This is March. I mean, we're going to revisit those February and March lows, in my opinion. This is a 1 year, so you could see kind of, we hit the lows, we bounced, never hit the 200-day moving average, and now we're going down for the count again. And if you look at my other stock, so this is Holy Frontier, HFC ticker symbol. Wouldn't be buying this stock. I'd be selling the stock. Next one, and Holy Frontiers, what do they do? Engage in refining petroleum. Well, good luck with that. It's costing you more money to refine petrol, to buy the petroleum, to refine it, than it is that you're selling it for. So it's a mess right now. And I mean, 1 year return, 2 years return. Look at all these numbers. They're all negative. The only thing positive is earnings growth in 5 years. Everything else is, and what do? Refining and marketing oil. Not an industry to be in. Second one is FANG. Diamondback Energy, ticker symbol FANG. First one is HFC, second one is FANG. What do they do? Oil, natural gas company focused on acquisition, development, exploration, and exploitation of unconventional onshore oil and natural gas. Look at these 5-year return, 3-year return. They're awful. They're just awful. Technical chart. Let's take a look. Yep, breaking down, breaking below 50-day moving average. I wouldn't be surprised if we tested the lows. We're at 35. I think we're going to be going back to the $20 level. So again, I'm not liking FANG, and I'm not liking Holy Frontier. Diamondback Energy, ticker symbol FANG is a sell, and Holy Frontier, ticker symbol HFC is a sell, and I've explained to you why. Energy prices are going lower. Energy prices are cheaper. There's just not enough of an upside there, all right? So again, keep in mind, there's a sell-off happening in the energy market, and that's the sector that's on my chopping block, and I gave you 2 stocks. And although the stocks that I picked a few weeks ago or whenever that was, they're not doing anyone any favors either. Now, listen up. I've got something really, really important, and I would hate for you to miss out on this. Former hedge fund manager Lance Ippolito, he's ready to hand you his #1 growth stock for 2020 at 1 p.m. Eastern Time today. But before he can do that, you need to watch the emergency message that he has for you, specifically for you. There's one stock in there that could hit his $10 mark, meaning it's still trading for practically pennies on the dollar. And that's why major players are starting to pile in right now. Before you do anything else, click on the link below to see why you need to get in on this $10 stock. I'm going to review this again. You got Lance Ippolito, who is an amazing trader, ex-hedge fund manager. He's going to hand you his #1, not #2, #1 growth stock for 2020, 1 p.m. Eastern Time today. He's got an emergency message. He's got one stock that could hit his $10 mark. It's literally trading for pennies. You don't want to miss out. And Lance knows what's up. Folks, literally, before you do anything else, click on the link below to see why you need to get in on this $10 stock. Heck, I'm going to contact Lance and find out what it is before it too. I want to get in on it too. Be there, 1 p.m. Eastern Time. Talk to you guys soon. Have a great day.